Hi, Kevin Wright here, and welcome along to another weekly finance tip video. What's the subject this week? We're going to delve into a little aspect about bridging that sometimes confuses people, and that is how exactly do bridgers charge interest on bridging loans? So keep watching and let me explain to you how bridgers think on this subject. How bridging interest is charged is obviously a key component for you to understand if you're going to use bridging finance. Now, there are three ways that it's charged, so I'm going to tell you what they are, and then we're going to drill down into the detail so you understand how the implications of each. So we've got, number one is retained interest, number two is serviced interest, and number three is rolled up interest. Okay, so there's the three. Let's drill down. Now, look at retained interest first. So this means that for the term of the loan, be it, I don't know, 6, 8, 12 or whatever months, the bridger retains all the interest day one at the start of the loan. So they keep it all back. There's no monthly payments for you to make. Now, sometimes that, if you're doing a refurb project, not having to make a monthly payment can be advantageous. So why do bridgers do this? Well, simplification, really. Now, if they've got all the interest payments up front, they're not sitting around each month waiting and wondering if you're going to pay it on time, whether you're going to be a bit late or whatever. So it's simple for bridgers to charge it this way. Let's look at a very simple example. I like to use round figures so that you get this at a conceptual level. So let's say you've got a gross loan of 100,000, and let's just say that the interest is 1% a month, so £1,000 a month, and you've got it on a 6-month term. So therefore the interest for the term is £6,000. Now, when bridgers retain it, they will actually deduct it from the gross loan, and you get the net loan passed to your solicitor, who will give it in to you and put it in your bank. So 100,000 is the gross loan. 6 times £1,000 is 6,000. 100,000 less 6,000 is 94,000. So 94,000 is what you actually receive. And then at the end of that time, you pay back the 100,000. So if you kept it the whole 6 months, you'd pay back the 100,000 that you borrowed. So that's retained interest. Now, this is the most common way that bridgers structure the interest charged on their loan. Now, the next one, let's look at the second one, and that's serviced interest. This is where you pay monthly. So this is the most familiar to you if you've had mortgages. And what we're seeing here again is that if you approach bridging with your mortgage buyer mindset, as I like to call it, you'll find it quite confusing, because bridgers think counterintuitively in almost all areas compared to mortgage lenders. But in this case, they're aligned. So what you're saying to the bridger is, and we'll use the same example, 100,000, 1% a month. Of course, it could be cheaper than that, but let's use it simple figures. 100,000, 1% a month, 6 months. So you would need to make a monthly payment on the serviced interest option of £1,000 a month. Now, what the bridgers now are interested in is, can you afford that? So they would want to, before they agreed, they would want you to send them typically 6 months bank statements, and they're looking for how much money have you got left over at the end of each month to service a £1,000 payment. So the key point here is net residual income. So what they're looking for in this example is that what you earn against what you spend, you've consistently each month in your bank statement, you're left with a residual unspent income of in excess of £1,000. Now, if you've got that, then they're likely to approve you servicing the loan. If you haven't got that, and there's a lot of us that don't have that much money left over, and the fact that payday loans exist mean that a lot of people have too much money or too much month in the money. So if you haven't got that, then your request to furnish it monthly and service it monthly will be declined and will revert back to retained interest, which I explained earlier. So serviced interest doesn't happen that often. Sometimes there's a hybrid between retained and serviced. So for example, if you've got a 12-month bridging loan for whatever reason, and you're going to be renting it out, let's say after 4 months or after 6 months, you could do a mix of the two. So the bridger would say, well, look, while you've got no income, let's retain that interest. So we'll retain 6 months interest, but after that, we're going to let you service it. So that sometimes happens. Not very often, I must admit, but it does sometimes happen. So we've looked at retained, we've looked at serviced. Now let's look at the third one, rolled up interest. So rolled up interest means, as the name suggests, from the beginning of the loan, they just add the interest on and you settle and pay it back when you redeem the loan, either because you've refinanced the property or you've sold it. Because remember, those are the only two ways you can pay a bridging loan. You either sell it or refinance. Really simple. So, rolled up interest. Now, in the majority of bridging loans, that doesn't work. Let me explain why. Now, your natural tendency, if you're like most investors, is that you're going to want to minimize your deposit. So you want to put down as little cash as possible. To allow you to do that, unsurprisingly, the bridging lender has to maximize the loan. So if you're at the maximum loan day one, then if they added the interest on and allowed it to roll up, then you're going to go over the maximum. And clearly there wouldn't be a maximum if they allowed you to go over it. So therefore, on the majority of purchase bridges, where you're just borrowing for the purchase, you're not going to have the option to roll up the interest because it would take you over the maximum. So it's a closed off option, and you either have serviced or retained as the option. There is an exception, however. So now let's look at that. The exception is a refurb bridge. And this is where they're not only lending against the purchase, but they're lending against the money you're going to spend refurbing it. Now, if you check out one of my other videos, you'll see we're talking about how to fund refurbs, and I reference refurb bridges there. So here, on this type of bridge, they are happy to let you roll up the interest. And here's the difference, here's the reason why. Because with each tranche of money that they release to you to do the refurb, you're actually adding value to the property. So now, the value you're adding as you go through your refurb is meaning that they can allow the roll up of interest to happen to increase effectively your outstanding balance, but still keep within the parameters that they want to do so they feel safe, which is typically 75% of the value. So in a refurb bridge, you will get to be able to use rolled up interest. Okay, so now you understand how bridging interest works. Unlike most things, it's not quirky or fearful when you understand it. So that's it for this week. Hope you've enjoyed this video. Remember to subscribe if you haven't already, so that you don't miss any future videos. And I look forward to seeing you next week.